Hello everyone, my name is Oystein Vaagen. I'm an equity research analyst covering shipping equities at Fearnley Securities. Today, so last but not least, the public tankers segment or panel. We are joined by Gurnee, CEO of Ardmore, Christian Ingerslev, CEO of Maersk Tankers, and Valentis, CEO of Pyxis Tankers.
And Carlos Mottola.
And here we have Carlos as well. Carlos Balestra, the Mottola, the CFO of Davico. So, as I started out by saying,
good dramatic entrance.
Last but not least, it's fair to say that product tankers probably is one of these segments within shipping that has had the most interest throughout the year, given how rates have been moving and where they are today, which has also been reflected in the equities, on average being up at least 200% year to date. The question is now, how high can we go, especially going into the winter season? Is it sustainable? How long will it last? And also, probably talking about given where earnings are today, what will you guys use your money for going forward? So, if we start with Anthony, before we kind of get into the future, if you could give a brief overview of how did we get to where we are today, what happened this year, and probably talk a bit about rate differentials in different regions of the world, which is also quite important.
Happy to do that, but first, just have a schedule question. Are we ending at 5 or 5:20? Because drinks start at 5. I don't think we're not going to keep the audience for this long. So, yeah, if at any point you want to cut us off, just go ahead and do that. So, yeah, I mean, how did we get here? Well, I mean, in short, I think probably most of us felt that 2022 would be a good year because we saw the continued recovery from the pandemic and very constrained supply. And obviously the war caught everybody off guard, and it's kind of turbocharged the market, but we did think, and we still do think, that the fundamentals were quite solid behind that. What was the next question?
Maybe a bit on the rate differentials between regions.
Yeah, no, I think it's a good point, and I think it's a good question because when you're looking at any sector in shipping from a distance, there's a tendency to look at one rate and think, okay, well that's the global average, but there's a lot of variability, and I think what's interesting about that, and in our sector, is that there have been quite significant differentials between the markets, largely east versus west. But what's interesting is that at all times, really since February, one of them has remained quite strong. So we haven't seen both dip at the same time, meaning that it's really just a kind of a global tonnage allocation, temporary. But overall, rates in the east have been stronger for quite a while. Right now, probably the average MR rate has come off a little bit, but it's probably still around 50,000 a day. And in the west and the Atlantic, it's been maybe 35,000, 40,000 a day. So average maybe 40, 45. So.
And so maybe Christian, you can take this question.
If it's good, I'll take it.
If you look at call it the rate momentum that we have right now, how much would you contribute to call it types of or different types of inefficiencies that could easily unwind, and what are your thoughts on these inefficiencies going forward?
So there's no doubt that whenever a system like shipping gets disrupted, then it gets sub-optimized. And we really saw that on I wish I could say the 24th of February when the war started in Ukraine, but the reality is it's probably more towards the end of March. And we saw a rapid shift, people moving ships out of Europe, and you also saw trade flows change quite fast. So that's, of course, one element that disrupted it. The second element that had disrupted it is that I think it's fair to say if you look at the number of ships that have been sold this year, then there are a lot of buyers that are called undisclosed buyers, and they have acquired quite a lot of ships. Because we are distinctly seeing a two-tier market that has developed, where you have the fleet that's trading Russian cargoes and the fleet that's not trading Russian cargoes. And those two fleets are completely separate. And that, of course, again, creates inefficiencies. Now, how long will they last? Well, if you can tell me how long the war lasts, then I'll probably be doing extremely well. But my personal sense is that it's probably going to last for a while, and it's those inefficiencies are going to stay in place even with the new sanctions coming in, and we're getting a bit more clarity around it. So fundamentally, I think the momentum is strong, and I think it's going to stay like this for quite some time. Full well recognizing that there are a lot of other factors that are pulling in the other direction as well.
Yeah. And maybe before moving into the outlook for 2023, let's talk about the winter season. So there's one thing going into the summer season with low inventories, but going into the winter is something different. So maybe you can take this question: if, let's say, how high can rates go? Is there any upper practical limit on rates?
Okay, the market has been on an upward movement, but there has been volatility in the last 6 months. So although we have seen some spikes in the market, which were very healthy, we also seen some lows. So it's not that the market will continue in a specific way. What is an indicator for us and how the market will behave in the future is time charters. And then in the period front, we see now a lot of charterers actively looking for vessels for 3-year period or for 5-year period. This is an indicator that the market will remain healthy for a substantial time going ahead. As far as inventories are concerned, yes, this has been a major impact for the market. Inventories are low and historically at historical low levels, and therefore there has been a lot of replenishment. In addition, let's not forget, what happened in the beginning of the year, February, March, the economies were strongly coming out of COVID, and therefore there was a lot of demand for products such as jet fuel, diesel, etc. And in addition to that, we had the developments in Ukraine and Russia, and this has added to the market fundamentals. And considering also the order book, which I'm sure we'll discuss later, these are very good signs going on for the future. I cannot tell you a number, if that's what you're asking, Oystein, but if you're looking for numbers, today a modern MR, Eco MR, is fixed for 3 years at approximately 24,000. And if you're looking for a longer period, 5 years, it should be around 21 to 22,000 if their counterpart is there to take vessels for 5 years.
Yeah. And one point which I've actually heard Anthony talking about earlier, and at a different seminar, is if you fix an MR at $45,000 per day, it's roughly around 5% cost of freight in terms of the cargo value. It's probably a hard question to answer, but how high can this percentage go before you start hindering shipping? Also keeping in mind how much traders are earning right now. If anyone has an answer, maybe Anthony.
Yeah, I mean, it's anyone's guess, but it's certainly, rates could easily double, and I don't think it'd have an impact because it's really, it's not, you're down to people just needing the, the cargo in a certain location. So, so I think practically speaking, rates could probably triple, from here. So, yeah.
We can look at other sectors. Yeah. You'd have VLGCs making more than $300,000-$500,000 a day. You've had VLCCs trading at those levels. Why shouldn't you be able to get ships like this at a much higher level? So it's also somewhat of a mental barrier at times. But as you're saying, from a sort of freight component perspective, it's pretty marginal. And that's not what hinders transportation.
Can I just add something? I think we're all fixing ships occasionally over 100,000 a day. And, it's not every fixture. Obviously, there are a lot, that are below 50,000 a day, et cetera. But the point is that somebody is paying 100,000 plus for transport, okay? And so there's obviously a need. So we're already kind of, seeing occasionally rates that are effectively double the market average. So,
yeah. No, I'll add to that only that even before the war, we were already seeing very different economics for refineries in different locations. Of course, there are much more modern refineries which were built recently, which are being built, which have much higher margins, which are much more sophisticated. But now we have also a unique situation where refineries in some countries have access to crude oil at a very different price. And therefore their margins are further enhanced. And you know, if you are buying crude oil at $30 per barrel discount, $40 in some cases maybe, then the freight you can pay is significant, and you can still earn a very good profit. So there's a lot of profit out there today for the refiners, for some refiners in particular, and for the traders, and that is one of the reasons why the market is very strong and can be even stronger going forward.
Yeah. And before we talk more on 2023 and the upside risks that we see now, let's say you get back to a recession in Europe and the US next year, and what are the downside risks for product tanker shipping, and what happened the last time around? I would leave that open to anyone who wants to answer that one.
May I? Well, the refined product trade has always been correlated to GDP, worldwide GDP. Latest predictions are for 2022 revised at 3.4% growth, and for 2023 approximately 2.1% growth. Although besides the lower predictions for growth, I mean, the predictions for consumption of refined products, according to the IEA, is higher. So for 2023, they are projecting a 1.7% increase in refined products demand. So I guess this says it all, that despite the recession, the demand for product tankers is pretty healthy.
Perfect. With a bit more on the crude side, you're seeing OPEC cuts not being obviously 2 million, close to 1, maybe a little below, what we believe. And then you have SPR releases also ending. Is it possible that you might start to see some spillover effects going into the product space in terms of switching capacity, etc.? Carlos?
Well, you have to take into account that this year oil supply generally should increase by the end of the year by 4.6 million barrels per day. And even taking into account the OPEC cuts, which were recently announced, I mean, the headline figure is quite impressive, 2 million barrels per day. The actual cuts, since many countries were producing well below their quotas, is probably closer to 1 million barrels per day, maybe even slightly less than that. We are still assuming that the International Energy Agency is still forecasting an increase in oil supply next year of around 0.8 million barrels per day. So I think that the crude tanker segment, which is already doing quite well right now, it has improved significantly. I mean, the Aframaxes and Suezmaxes have been doing well since the onset of the war, but most recently also the VLCCs are doing very well. They should continue doing well next year also because their order book for once is under control, and fleet supply next year for the crude tanker market should be quite limited. And therefore I actually see positive spillover effects, not negative spillover effects coming from the crude tanker segments. I mean, we have done, usually, the first sector to rise is the larger vessels and the crude tankers, and then the product tankers follow. This year we did well, despite the VLCCs in particular not doing that well. I think next year we could have some positive pressure being exerted by a much stronger market also in the crude tanker sector.
Yeah, understood. Christian, one of the things that's on everyone's lips for the product tankers is the upcoming EU embargo in 2023. So it will become effective in early February of next year. How important is this embargo for a continued strong rate environment in products? And then we can talk about the risks from it after, but how important is it?
So our view is that it's going to have quite all other things equal, it's going to have quite a positive impact on the demand for product tankers. It's approximately 1 million barrels a day that today goes into Europe. It's short haul from Russia. And all of that will be displaced. Russian oil will go longer distances. And of course, there's a discussion about whether will they be successful in selling it. But I certainly think so. And then in turn, Europe will need to source it from elsewhere, which is probably going to be the Middle East. So our assessment is that, again, all other things equal, then it will lead to a demand increase by 4 percentage points, which is quite significant in an industry that has 3% fleet growth next year. So of course, there are factors that are pointing in the other direction, but it's a rather significant increase. And I think it's only going to strengthen the separation between what we consider sort of shadow fleets and the you can say the non-Russian market. So I'm quite constructive about what happens in 23, but I'm perhaps also a bit more bullish than most when it comes to that.
Perfect. And maybe Anthony, what do you guys see as the main risks of the EU embargo actually coming into effect? Do you think if diesel prices continue to go as they go, what are your views on that?
Yeah, I guess we're already looking at a very tight market, so any demand that you layer on, from this, I think is going to really move the market. So, even if it's only 1 or 2%, it's really significant. It's different from 1 or 2% a year ago. It's adding on top of arguably already 6-7% growth.
And, apart from specific events such as the EU embargo, the world still really hasn't recovered on, for example, jet fuel demand. Pre-pandemic, you're roughly 70% compared to where we were. And you have a supply situation, as probably everyone has heard throughout the day, which is extremely supportive for the product tanker space as well. Supply is basically fixed for the next 2 years. Eddie, what's your view on the entire 23 as a whole right now?
On the supply side, on the MR front, which is the workhorse of the industry, and our company focuses on that, the order book currently stands around 4.7% for the next couple of years, which is the lowest we've seen for quite some time. Approximately 45-46% of this fleet is coming in 2023. Of course, there are also delays in the deliveries, etc., and the new buildings placed are very little. So we're very hopeful that this order book will remain stable, if not declining, because of the uncertainties ordering new vessels today, prices as well, and of course technology. Therefore, we're very confident that the order book will, and the supply side will be very comfortable for the next couple of years at least. I'm talking about the MR sector, which we are focusing on, but I'm sure the LR2, LR1 are approximately the same.
You should smile more when you say that. It's good.
Yes, very good.
Yeah, and it's also important to touch upon, which I think most panelists have talked about, environmental regulations. How much effect? Do you think you'll see a lot of effect of that on the fleet already in 2023? Or is it more, call it a measuring year, and you'll see more of the actual effect on supply in 24 and 25? Maybe Carlos, if you want to go ahead.
There would be some effect, possibly. If we look at only our fleet, which is of 36 vessels, we only have really 6 vessels which are going to be affected by the new EEXI regulations. And we are going to be installing energy savings devices and derating a bit the engine power, but we'll still be able to maintain speeds of 14 knots. And so I think that the effect will be minimal. Maybe on all the vessels it could have a bigger effect. The CII might have also an effect, but I think that will take longer to kick in, because unless you are an E-class vessel, you need to be classed for 3 years in a row as a D-class vessel for you to need to take corrective action. So, I think it will have a minor impact in the market, but there are many other factors today which are predominant.
Also, let's in the supply side, we should also add the scrapping. And this is very important, although we haven't seen much scrapping this year because the rates have accelerated. Let's not forget that from 2023, approximately 120 MRs will be above 20 years of age. So whatever that means for trading and for decisions going forward, according to what Carlos said about the EXI, etc., this will be, I guess we will see accelerated scrapping from the beginning of next year.
And it's maybe not, I think we covered the supply side quite well. It's quite simple. It's looking extremely supportive for product tankers, and it's looking probably the best it has in several decades. So, and it seems that you all have quite a similar view on the future. I probably know the answer to this, but it would be good to hear your thoughts on, maybe if we start on Anthony and move down the line, as Eddie spoke a bit about earlier. Are you guys looking at taking more coverage, going longer term? What's your view on spot versus long-term coverage?
It's something we think about every day. In fact, we have our head trader in the audience here, so we'd almost be better off asking him. But it's when you our sector is fundamentally a spot trading business, and there's a lot of one-year TC, but that doesn't really buy you a lot of risk reduction. It's really just a kind of a bet on the near-term direction of the market. It does feel like the future periods are very heavily discounted. If you look at what we expect, even if this current market ran out through the winter versus a one-year rate or 1 year versus 2 years, it just feels like you're giving away a lot. And so, when rates come up to levels which looks like you're being rewarded for those periods, we would consider it. But also, if we go beyond a year in our business, it's quite thin, and you have to worry about counterparty risk and other things.
Probably historically it hasn't been a lot of multi-year charters in your business, but
not a lot, and they tend to default. So.
Carlos?
We as a company, we usually have a strategy of covering quite a high proportion of our fleet with period contracts, between 40 and 60%, but we're actually much more open today. If we look at Q4, we only have 18% coverage, and next year 7%. And the reason for this is that we decided to take short coverage whenever we did recently, because we wanted to be open to the market recovery, which we anticipated was arriving. And throughout this year, we refrained from taking additional coverage because we felt that the period rates were not there where they should be, where the fundamentals of the market are. We are now seeing that there is a bit more of a realignment, so we will consider possibly taking more coverage, but we are not in a hurry to do so. I mean, we see that 1 year ECO-MR rates are above 30,000, probably around 32, 33,000, and for ECO-LR1s around 43,000. And those are undoubtedly very attractive levels, but also the fundamentals of the market are. So what we are also seeing is that some oil majors, some players, when they do want to take coverage, they want to take longer coverage. And as Tony pointed out, they want to take longer coverage at rates which are significantly discounted relative to the 1 year rate. So we are not very keen on that. But it also indicates that they are concerned about the market longer term, and they want to secure tonnage for 2-3 years because they realize that the prospects are good not only for next year, but probably for the next 2-3 years.
So Maersk Tankers is a commercial manager, and we manage 170 product tankers for 40 different owners, and we trade everything spot, because we fundamentally believe in scale, and we fundamentally believe that if you want to make money in tankers, then you need to have your asset available when the spikes come. It's super difficult to predict when the spikes come, and a lot of it has to do with geopolitical factors or environmental factors of which we're not in control. So when you put your vessel out on time charter, well, then it's great that the market spikes, but you can't take advantage of it. But when you're in a pool, you can. So we trade everything spot, we do everything short term, and we do everything we can to ensure that our owners have the assets available to sell them if they see that as an opportunity, to lock in long coverage if they see that it's an opportunity. But for now, it's really just take advantage of everything we can in the spot market. And that's what we intend to do, and that's what we see our owners wanting to do as well.
As a small publicly traded company, we have a balanced chartering strategy. Usually we have both vessels in the spot market and period employment. Today, most of the vessels are in the spot market, and we consider that the coming winter will be strong. So, of course, if we see the opportunity to lock in periods, we will do so. Visibility of cash flow is very important for us, and I think this is a very good timing to be locking in period in case the rate makes sense.
Perfect. And moving a bit more over to maybe capital allocation, as we've spoken about today, the supply side is looking fantastic. Demand side is looking good. You probably have some, or you have some upside, especially upside risk to the upside entering the winter season. Given where rates are, you're all earning a massive amount of cash. If we talk a bit about maybe on the company specifically here, what are you guys planning to do with the cash? Will it be buying vessels? If so, what kind? Distributions? Are you looking at scrubber investments or so on? If we start with Anthony.
Just checking on the time now because we're cutting it to happy hour. Should we keep going? So, okay. Sorry. I'm just thirsty. No, look, I mean, it's definitely the case that we're generating a lot of cash flow, and so we're rapidly paying down debt. I think by the end of the year, we'll be under 30% debt to capital, which is nice. And in accordance with our long-standing capital allocation policy, we'll most likely be reinstituting our dividend when we get to that point. So.
Carlos?
Yeah. We are looking as a priority to deleverage, to position.
You said the beverage.
The beverage.
You said happy hour.
Sorry.
Yeah. First the leverage and then the beverage, we are making good progress in that respect because of the strong cash generation, we will look also to pay dividends most likely next year. It makes sense, so we will do that. In terms of capex, no, we are not looking to buy new buildings for sure, but we are also not looking to buy second-hand vessels. We do have a purchase option on a vessel time chartered in, which is in yen, and of course, because of the yen's strong depreciation, that is at a very attractive price. So we exercise one of these options on another vessel on TC-in, and we might exercise a further one soon. And then we have vessels which we lease, where we have purchase obligations, and we can obtain significant savings by exercising these options. So we will look into that.
So I have the joyful opportunity of managing a commercial manager. So we don't own any assets. But I think what most people are really doing now is either they're taking cash off the table or they're just milking whatever assets they have out there in the spot market. It's really hard to justify new buildings, not just from a cash point of view, but really the uncertainty around the technology. What's going to be the fuel of the future, but also the fact that that will have negative implications, whatever fuel there is, on future demand. So in many ways, that's a really good thing for product tankers, because as long as the regulation is uncertain, people are going to wait and see. The order book will get smaller and smaller, and that will really allow us to sustain the stronger earnings for quite some time. It's nice to see this room being filled up again with people who are interested in shipping. It looked a lot different a few years ago, but I think it's fair to say that sort of the investor interest in this side of the industry has been smaller again, which I think is super attractive for those who are willing to be here. So thank you for being here.
We're obviously strengthening our balance sheet, and Although we are a growth company and we would like to expand our fleet, this is obviously not the right moment. Asset values are very high currently. So we would not rule out paying down debt. Interest rates today are significantly higher than last year, therefore it makes sense to pay down debt. And why not, if we could pay some dividend with whatever amount we have at the end of the year, which can be allocated to paying dividends. Might be an idea for us, yes.
Perfect. I think the key takeaway is probably that there's risk to the upside here, especially going into the winter season. Supply side is looking good, cash generation is strong. So I think that kind of rounds it up. And what you typically say is that when the room isn't, or the room use is usually completely full when you're at the peak of the season, even though it's happy hour that they were talking about earlier, it seems that we're still not there. So with that, I say thank you to everyone listening and the panel.
Thank you.